This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. US crude prices falling at the Asia Open on hopes for Middle East peace talks that could reopen the Strait of Hormuz. Reports say Washington has given Iran a 15-point plan to end the conflict and may be seeking a one-month ceasefire. Also ahead, Philippine President Ferdinand Jr. tells us exclusively that the war could spur talks with China on oil and gas cooperation in disputed waters as he declares a national energy emergency. And we'll be asking New Zealand Finance Minister Nicola Willis about how the Middle East conflict will affect inflation and the budget bottom line. Well, at the moment, we are seeing some alleviation of worries across Brent and really oil markets and broader commodities as well. Take a look at what we're seeing with oil at the moment trading. When it comes to New York traded oil, we're down about 4%. They're all on these reports that there's diplomatic overtures. We have this report of a 15-point plan being sent from the US to Iran. President Trump also making other remarks on that, but also news that we are hearing reports of 2,000 troops being deployed to the region as well. If you take a look at how we're trading across other assets, a sigh of relief when it comes to gold, snapping that 9-session losing streak. They're pretty steady as it goes when it comes to trading in precious metals at the moment. At the open, we're seeing that relief rally play out, Shery, with Australian stocks up by 1.25%.
Haidi, to your point, it was really a headline-driven price action in the overnight session over Wall Street as well, right? I mean, the comments, especially with President Trump saying that Iran had a big presence around the Strait of Hormuz as a show of good faith, really led the S&P 500 to reverse most of its losses. It was still down at the close, but take a look at U.S. futures at the moment gaining ground. We have seen treasuries continue to fall, inflation fears given the oil surge. Also, we had a weak 2-year auction. A different story here in Japan where we had solid demand for 40-year auctions, so we had JGBs gaining ground. We have heard from authorities here in Japan that they signals a potential intervention in crude futures, given the pressure that that's exerting in the FX space. We have seen the Japanese yen trading around 158, 159 at the moment. Nikkei futures pointing to the upside after a session of gains as well. We're watching the tech sector as well. We've heard from SK Hynix in a regulatory filing that they may be ready to list their shares in the U.S. And of course, we continue to hear this commentary coming from all countries around the world, the necessity for peace talks. Wang Yi, the latest one, calling for negotiations. And you can see right there, Chinese A50 futures closing to the upside, Haidi.
And all of this down to the geopolitical story, right, Shery, with President Trump saying that the US is in negotiations with Iran, signaling that Tehran had offered an unspecified present related to energy flows as a show of good faith. Media reports in the US and Israel say a diplomatic push for peace is gathering pace, suggesting the Trump administration may be seeking a one-month ceasefire.
They have no Navy left. They have no Air Force left. They have no anti-aircraft equipment left, no radar left, no leaders left. The leaders are all gone. Nobody knows who to talk to. But we're actually talking to the right people, and they want to make a deal so badly. You have no idea how badly they want to make a deal.
But all the talk of diplomacy coming at the same time as Iran maintaining its grip on the Strait of Hormuz. Israel says its military campaign will continue at full intensity. The Pentagon said to be ordering 2,000 troops to the region. Let's bring up Bloomberg Politics editor Laura Davison. And Laura, as we speak, the IDF posting on X saying that they've begun another wave of strikes at targets across Tehran. So on the balance of things, what do we make of these latest developments?
Well, we have a bunch of mixed messages. It's clear that markets are listening to what Trump is saying, that, there are diplomatic talks that are gaining pace, reports of this 15-point peace plan that the U.S. Reportedly has sent to Iran, as well as, perhaps a talk of a one-month ceasefire, rather. But we have a bunch of other data points that sort of point to the opposite of rather, escalating attacks, an additional airborne division of U.S. military being sent to the region on top of Marines that are already on their way. This successive waves of attacks from the Israelis into Tehran hitting just now. So there's a lot of different pieces here that, really that this could go either way. Iran also has not suggested they are engaged in these talks. Trump has said that the Iranians have offered a present. Meanwhile, the Iranians have said no such thing.
And it's very difficult for Gulf states to actually intervene in this conflict, right? What do we know about how ready they might be, especially given that energy infrastructure is being affected now?
Yeah, the Gulf states have been really reluctant to jump into the fray here, citing sort of longstanding tradition and also just, that Iran is their neighbor. And even long after this conflict, they will need to, maintain some sort of relations with Iran, uneasy as that might be. But because of the sort of the escalating nature of these attacks, that some of their infrastructure, both military as well as civilian, things like water desalination plants, might be under attack. They are, the UAE and Saudi Arabia in particular have been, mulling perhaps jumping into the fray, if they feel that their things are in danger. Closest diplomatic sources are saying that they may be willing to jump in. We've already seen signs that they're willing to do more than they have in recent weeks, things like offering up their Air Force bases, airspace, and other sort of tools to help the U.S. and the Israelis in these attacks.
What's also been an interesting development and pattern is seeing Iran, allowing these vessels through the Strait of Hormuz and through safe passage if they've been sort of deemed on the right side of this war.
Yeah, this is a really interesting development. We saw over the weekend an Indian tanker pass, and now in the past day or so, this Thai tanker pass. Iran has signaled that non-hostile ships, those that are not committing acts of aggression, basically they're sort of implying essentially non-Western ships can pass through. They are charging a fee. They still have very much a clear control over the Strait of Hormuz, but they, are looking kind of at ways that they can sort of exert their power. This, of course, is a far cry from what Trump was talking about yesterday and having U.S. and Iranian joint control of the Strait of Hormuz. So kind of where both the sides are here could be a very far cry apart.
Bloomberg Washington Deputy Bureau Chief Laura Davidson there with the latest on the Iran conflict. Risk assets in focus as investors weigh reports that the U.S. has sent a peace plan to Iran. Senior editor for markets and Bloomberg opinion columnist John Authers says upside risks will likely continue to support share prices. John joins us with more on his views. John, we have a very confusing news flow at the moment. We're trying to figure out where the negotiations are, if there are any negotiations. So far, we've seen markets supported in any instance of President Trump's crises, whether it's tariffs or anything else, the taco trade. How much can we rely on this when President Trump doesn't necessarily seem to hold all the cards?
Well, we can rely on it less than with previous examples of the taco trade, simply because he doesn't, on this occasion, have a willing counterparty to play along with the same game of giving him a victory. It's very important for Iran, given that they want their regime to survive, that it not be seen to have handed him a win if they can possibly avoid it. I do think, and this is what I was writing about in my column yesterday, there is a long history of big geopolitical shocks like this creating really great opportunities to buy. And we have had quite a noticeable sell-off. People are going to be very nervous to sell off too much further at this point, simply because if you do get a deal, which still seems pretty reasonable to suggest that we will do, that we can avoid total disaster, then this will look in the future like a buying opportunity. People don't really feel like selling to give somebody else that opportunity. So I guess it doesn't surprise me hugely that the markets are still as relatively calm as they are. It surprises me a little that the pronouncements of Donald Trump are being taken as seriously as they are, given how much he varied over the weekend and how much this is a situation where we need both counterparties. We need to know what both people think. I think we've definitely established that he wants an off-ramp if he can find one. We don't yet know whether Iran will offer him one, and that's the key thing we need to find out about.
John, when you're talking about the opportunity for buying, you make the very good point that you would typically need to know that we're at, near, or perhaps past the worst, the peak of any sort of risk scenario. We don't know that, though, do we?
We don't, no. And that is, I think, one of the more interesting facets of this conflict. It's going to be quite difficult to gauge whether we have got to that point. I think if you got a 1-month ceasefire, which I'm sure that the US would like such a thing. I find it a little hard to believe that they have managed to offer Iran enough that they would be prepared to accept it. A 1-month ceasefire, however, would be such a clear sign that the parties were aligned in not allowing things to go further. That would, I think, be the point at which people started to buy, that there would be that confidence. And that would explain why we're not getting much more aggressive sell-offs in response to the amount of bad news that we definitely are having. Israel is still talking very tough. Iran is, as you've said, still making it very clear that it is completely in control of whether you go through the strait or not. And the US is sending 2,000 troops from the 82nd Airborne. You can perfectly easily construct a very negative narrative. It's just that people are very conscious at the moment of those upside risks, and some of the comments Donald Trump has been making speak to those upside risks.
And John, we're also hearing from central banks, the RBNZ governor talking yesterday about how they will not be rushing to raise rates because of the Middle East conflict. How do central bankers' commentary and expectations also factor into the markets?
I mean, that's another critical factor. If you look back to 1990, which in many ways the Saddam Hussein's invasion of Kuwait, which is arguably the most similar event in the last few decades to what's going on at the moment. The Fed ended up cutting, I think it was 5 times during the occupation of Kuwait, but they did wait until the oil price had peaked before doing so. They needed some confidence that this wasn't a spiral upwards in the oil price. And you could therefore argue that certainly the moves we saw in central bank expectations in the last 2 days have shown that investors are still dubious as to whether they really are going to hike. And as soon as there is any sign of easing in the situation, central banks are obviously still very happy to say they're not desperate to go, that they're not clear about a hawkish path. So yes, that is the other critical variable. We need to know exactly how bad the damage to oil supply, the enduring damage to oil supply, is going to be from this, and we need to know how central banks react. And yes, the news flow of the last 48 hours has certainly been relatively positive compared to where we were before on both those fronts, which would explain why markets are relatively calm.
John Olsen is there, our senior editor for markets and Bloomberg opinion columnist, joining us. Coming up on the Asia Trade, Fitch Ratings gives us their outlook when it comes to energy markets. We'll be speaking, of course, with New Zealand's finance minister about the war risks to the economy. And kicking off our coverage from the Boao Forum with JD.com's chief economist. Much more ahead. This is Bloomberg.
We saw emerging market assets gain ground in the overnight session. We saw the Brazilian real, the Mexican peso rebounding. We had oil under pressure early in the Asian session, continuing to lose ground. Of course, we have a little bit of confusing news flow, but markets digesting the potential of that present, according to President Trump, around the Strait of Hormuz coming from Iran as a show of good faith, and not to mention that there are reports of potentially a 1-month ceasefire. The Philippine peso, Taiwanese dollar, Indian rupee were some of the outperformers, and perhaps very lucky for the Philippine peso and a relief, because it's been bearing the brunt of the war's impact on emerging markets. This chart showing how much it's underperformed the Asian peers. The Philippines has just declared the national energy emergency that will be enforced for 1 year. President Ferdinand Marcos Jr. also telling us exclusively that the conflict in Iran could spur a breakthrough in energy talks with China.
I think it's certainly going to happen. I don't think that's something that that is like an option. It's happening now. There's going to be a very, very serious restructuring. I remember I was watching Prime Minister Wong from Singapore, and he was saying we will have to redraw all of our even our legal relationships in terms of the international law, in terms of all of these things. They will have a lasting effect, and there will have to be a new normal.
Is there reason to think that maybe it is a good idea to have a partnership in developing the gas resources in the disputed areas in the South China Sea?
We've always tried to differentiate the territorial disputes from our trade arrangements. And many investments still of the big programs here of the government are coming from China. And they have not used this as somehow, they haven't leveraged this in any way. In quite the contrary, they've been very, very helpful in terms of, for example, fertilizer, which is, we import a great deal of fertilizer from China.
So would you consider developing gas resources with China in the disputed regions, areas in the South China Sea? Is that something you might consider?
That's something that we've been talking about for a great deal. But the territorial disputes will get in the way of that. Maybe this will provide impetus for both sides to come to an agreement.
The Iran war, do you support the U.S.-Israel war against Iran?
It certainly was unexpected, and we never want war. Our foreign policy is very, very simple. It's peace and the national interest. That's it. And war is never in the national interest as far as the Philippines is concerned. And so we just are hoping that this ends soon, and that whatever recalibration will be done as quickly as possible, so we can get back to work. And that's really where the Philippines is. We are watching, waiting, hoping, and praying that this ends soon.
The war has sent the Philippine peso reeling, 60 to the dollar. It's testing new lows after new lows. Do you think the BSP needs to tighten policy, to hike rates to support the currency?
As a matter of policy, we defend the peso to a certain extent. But I think, with the dollar moving the way it is, and it's moving. Whereas before, the dollar was seen as a safe harbor currency. When you look deeper into it, the dollar's movement increase in value has been really because they're the largest oil producer. And that's why that is. And considering that, then we have to, I think it would be even to be futile to try to spend all of this, all of our foreign reserves on defending the peso. The impact of all of this, of the war in the Middle East, is really to the middle income and the lower middle income countries, and we are a middle income country. And so that's why we have to look at that. The other side of that for the Philippines is the remittances. The remittances are paid in dollars, and so there will be an increase. But that doesn't make up for the drop in the dollar to peso.
One of the key challenges is the economy. The Philippines used to be one of the fastest growing in the region, now a laggard. Fourth quarter GDP was a mere 3%, which was the slowest pace in 14 years outside the pandemic. Can you get GDP back above 6%?
Yes, we believe we can. I mean, we were forecasting for the year 26. We were going to manage 6-7%. Between 6 to 7%, and that figure was something that we came up with internally, but as well the other financing institutions and the banks seem to have had the same opinion, because the improvement in our grade on S&P was going to improve. However, with the war in the Middle East, those have to be redrawn. Everything has to be redrawn. then of course, oil does what it does, but it was fairly steady at $72 per barrel for a good while. So those are the bases that we were calculating. Right now, things change every day. So we have to model that and recalculate that. So we'll have to see how long this problem lasts, how long it will take to readjust.
But how do you get to above 6%? What is the strategy? What's needed?
Of course, it's investment, because when it comes to production, perhaps our largest export in dollar terms is semiconductors, and that has been a very very important part. And we have now moved away, not away, but up the value chain from just pure fabrication to design. And that has put us in a very good position for the advent of data centers, of AI. And investment, of course, is most important as well. And so we have restructured even our tax incentives for investors. The ease of doing business is something that we've been working very hard on, bring down the costs of transportation, for example, to digitalize. Digitalization is key.
Jet fuel is the other component to all of this, yes. And reports have suggested that there's a lack of jet fuel and that perhaps Philippines Air would have to ground some of the flights.
With this scarcity, shall we say, or the limitations now on crude supply, the refining of jet fuel takes a longer time, and so we will have to depend on what is readily available. And already there are, when our airlines fly out, several countries have said we cannot fuel your aircraft, so you will have to carry the fuel there and back. And that's around here, where the long haul is going to be a much more serious problem.
So inevitably, planes will have to be grounded.
We're hoping not, but it's a possibility. It's a distinct possibility.
Philippine President Ferdinand Marcos Jr. They're speaking exclusively with Bloomberg Insight anchor Haslinda Amin. We have just heard from Philippine Airlines when it comes to this energy crunch, saying that they have enough jet fuel supply for operations, not giving any more details on that, but worth noting given just the increased pressure on aviation, on the sector and airlines around the world. More ahead on the Asia trade, this is Bloomberg.
Oil under pressure early in the Asia session. We had some positive news flow around the Iran war, leading to U.S. stocks rebounding slightly, still to the downside. You can see U.S. futures at the moment gaining 0.8% as we continue to digest the latest headlines coming from Iran. Also, we had tech under a little bit of pressure overnight, so do watch out for that. Software ETFs actually saw the worst day in about a month. Plenty more ahead. This is Bloomberg.
Take a look at some of the movers we're watching just half an hour into the trade in Australia. Downside again by these energy names that have really been performing so well out of the oil gains in this conflict. But at the moment, we're seeing that reversal as oil continues to temper these expectations. Reports of diplomatic pushes on various fronts between the US and Iran, reports of this 15-point potentially ceasefire plan. This even as we also hear reports of troops being deployed to the Middle East in preparation. So at the moment, this is what we're watching. Asia energy shares, as other markets open around this morning, should also see that drop there as well. We're also watching some of these big miners. BHP is in focus. There's been some very interesting comments coming out about the fertilizer market. They expect the global potash market to tighten over the next decade. Demand growing, these geopolitical risks straining supply chains, and that's one aspect that that we've been watching in terms of the broader energy crunch and how that's going to affect fertilizer supply shock, as we've seen that being triggered by the war in the Middle East. Well, Fitch Ratings says a prolonged war could affect multiple corporate sectors hit by higher fuel prices, supply chain disruption, falling consumer confidence and higher interest rates. But revenue and margins in some sectors could actually benefit. Let's get more from Fitch's head of APAC Natural Resources, Laura Zhai. Laura, really great to have you with us. And it's interesting that the remarks from BHP really highlight one of the key areas that have seen that disruption, right, which is fertilizer. Can you tell us about some of the sectors and industries that see the biggest risk and disruption at the moment?
Yes, of course. So last week we actually put out a heat map of what the prolonged Iran war is going to be like on various sectors that we covered. One of the things, this is based on an assumption that oil prices will average about $100 for 2026, with the assumption that the Hormuz will remain closed for a good 3 months. Of course, this is an adverse scenario, but under this scenario, we have broken down different sectors, especially under oil and gas. So for those of us in APAC, we've actually broken down oil and gas industry into 3 sectors, which is upstream, downstream, as well as oil field services. Of course, those are going to be most positively impacted is the upstream producers as the prices continue to gain. But what we see more of an impact is in the downstream, the downstream refiners that we see in the region, as they rely heavily on imports of products from the Middle East. Those in China, we've actually separated the region into China and ex-China in terms of Asia. China will be less impacted due to the large reserves that we have in hand, although margin erosion is still going to be there because the government continues to control retail prices on fuel. One surprise gainer from this is essentially the thermal coal producers in the region, as people start to see fuel switching. As you know, that Asia continued to rely heavily on thermal coal, and because more expensive oil and gas, of course, you're going to see thermal coal gain in terms of producers on revenues as well as cash flow.
Laura, we don't know when or how the war is going to end, but if we do see ceasefire talks, if we do see this being wrapped up in the coming weeks, let's say, how quickly do you think the disruptions could take to fade out? Will there be structural issues to contend with given the energy asset damage that's been done across the Middle East?
Okay, so when I explain this oil price things to the investors as well as media, what we always use that we call it a tug of war. So on the one hand, you have this geopolitical risk premium, which we're essentially talking about not what is lost today, but the fear of what's going to be lost tomorrow. And that's why you see the wide range of volatility throughout the day as we speak today, as of now as well, right? So part of it is that geopolitical premium. But we cannot forget that, the fundamental market is still oversupplied. So we're talking about when the Iran war erupted, oil prices went up $50 in a matter of days. You can just see it's coming down as fast as that once the war is over or once the war has been put into stop. I know there have been talks about, in disruptions and certain of the bombings on, potentially some of the gas refiners. But overall, the oil market is fundamentally oversupplied. We're actually expecting give or take 1.2 million barrels of supply growth this year, and that's coming out of completely non-OPEC plus countries. Before the war erupted, we're actually expecting a 2.4 million barrels of supply growth coming out of this year, and compared to a demand growth of give or take around 700,000 tons. And then you can see excess supply in the market. That's why originally we actually had oil price set at $63 on average for the year, and that has been raised to $70 earlier this month in consideration of that disruption of the war. Like I said earlier, we have to consider the long-term fundamentals of the oil market, which is essentially structurally oversupplied.
At this point, we're also hearing that some supplies are actually rising. But when it comes to perhaps that shortage that we're seeing in Asia, the Shell CEO now saying that could also spread to other parts of the world, including Europe. First of all, take a listen to what he had to say.
It's a ripple effect, Dan. We see, of course, South Asia first to get that brunt. That's moved to Southeast Asia, Northeast Asia, and then more so into Europe as we get into April. And so we are trying to work with governments to just alert them to the various levers they will need to pull, including on the demand side, including what they need to do around storage, what they need to do around purchasing stock, and so on and so forth.
Laura, aside from just crude production and, of course, those energy assets being fixed, what happens to the, say, petroleum byproducts like naphtha, for example, which Japan relies heavily on the Middle East for? Does it take more time to get those products out to actually also refine products? And of course, there's a long supply chain when it comes to all of these items that come just from the energy sector.
Sorry, can I just, so essentially you're asking the question on the byproduct, essentially the byproduct, the refined products coming out of the Middle East all the way to Asia. Is that, can I ask if that's where you're referring to?
So how long would it take for all of that recovery, not only about energy assets, but also about the byproducts and everything else that goes into different sectors, including even chemicals?
We actually, on the heat map, we actually have a fairly material impact on the chemical sector, precisely because of that. So if we're talking about, let's just say, a closure of Hormuz of around 3 months, the impact on chemical sector is going to be fairly severe. And you have to understand, chemical is already, the overall chemical sector globally is already on a very low margin trend, where a lot of producers were producing at below cost last year as well, especially here in APAC as we continue to add more capacities. That is going to be shot when we have oil and gases, which is essentially we're talking about 20% of the global supply cannot come through Hormuz. Essentially, what that will do is that it will push up overall margins and then erode supplies that we can push into the chemical sector. We are forecasting a fairly material impact in APAC in terms of chemical sector. I think the same thing is going to be on the same thing globally. One of the things we're watching out for is also demand destruction. Should this thing close for more than 3 months? We are essentially forecasting demand destruction of around 2.5% for the oil and gas sector coming from the chemical sector, as that was the major driver of oil and gas consumption in 2025. And that can actually expand all the way to 5.5% should the closure last for more than 6 months.
Obviously, aviation airlines is one of the sectors that are most pressured. We heard from flag carrier Philippine Airlines saying that it secured sufficient jet fuel supply to support operations for the foreseeable future. But so many of these airlines are sort of in the same situation unless they're very well hedged, right? Where do you see the most weakness there, and how quickly could we see a recovery?
We don't currently, my team, we don't actually cover airlines directly, but what I can tell you, the ripple effect of the reserves coming out to support the airline industry itself is that currently we are, for all the reserve sectors we're looking at APAC, is that most of the countries are okay staffed. Of course, the variances is different. So, for example, in China, we're talking about reserves over 120 days, or equivalent to about 15% of the global reserve. We're talking about 1.5 billion barrels of oil as reserve in China. The rest of the Asia, especially we're talking about Southeast Asia or the South Asia, where we're actually seeing stacking up of their reserves in the respective country. Take India, for example. Before this thing happened, India's oil reserve is actually a lot lower than 30 days. But then as of, I think, a couple of days ago in March, India oil reserve actually increased to 75 to 90 days. Though I think the Asian countries, especially those in South Asia, are increasingly pushing to increase their reserve during this time of crisis. However, let me pull you back to the fundamental supply. We're talking about, let's just say if Hormuz closed for about a month, we're talking about 450 million barrels loss. That is sufficiently covered by the global reserve that we have both in APAC, 400 million barrels of reserve that's being released by the IEA, as well as production increases outside of OPEC plus countries, as well as when we're talking about the pipeline, sort of the supply that's going to be shipped through the pipeline that's currently cannot be pushed through Hormuz. So fundamentally, the market is still well supplied for the next, give or take, a month or so. But then, things are always moving as we speak, so that I think that for now, things are still pretty well settled.
Laura Zhai, good to have you with us, head of APAC Natural Resources at Fitch Ratings. And some of the other global headlines that we're following, Chevron is warning that California is heading toward an energy crisis because of the Iran war, and state officials should declare an emergency. The company says it may quit refining oil in the state within a decade unless officials roll back taxes and regulations. California is highly exposed to the disruption as it imports about 20% of its refined fuels. Brazil will soon unveil a new program to provide financing to companies struggling with the impact of U.S. tariffs and the war in the Middle East. President Lula da Silva is set to sign a provisional measure soon, offering $2.9 billion in credit. According to a draft seen by Bloomberg, a wide range of companies may qualify, from manufacturing exporters to fertilizer producers. Venezuelan opposition leader Maria Corina Machado says a government led by her would allow the country's oil sector to go fully private. Speaking to oil and gas executives in Houston, Machado said that she would offer 25-year concessions and full property rights to investors. Machado also said she expects elections in Venezuela soon without giving a specific time frame. And coming up later this morning, we'll be live from the Boao Forum and speak to Fortescue Metals Executive Chairman Andrew Forrest and JD.com's Chief Economist Jianguang Shen. We have more ahead. This is Bloomberg. Disruption fears again in the markets. Overnight in the Wall Street session, we had software names under pressure. This on reports that Amazon Web Services is actually developing AI agents that could be replacing roles. So an ETF tracking software stocks actually saw the worst drop in a month. So we'll be following some of those software names across the Asian session as well, including the likes of NTT Data and Trend Micro here in Japan. Let's get more on that slump in the overnight session with our Asia tech correspondent Annabelle Jewelers in Hong Kong. So the disruption fear is really not going away.
No, that's right. I mean, of course, this is a group of stocks that's very sensitive to any headlines, but this reporting we got from the information is certainly something they are very sensitive to, but what they've reported, the information is that the cloud computing arm of Amazon, that's AWS, of course, is developing an AI agent to automate some of its functions for sales, for BD, and for other groups. And these are groups as well that have already been targeted in layoffs by the business. So that's according to the information, citing their sources. Essentially, but essentially an agent that could be handling some of the workload of thousands of different technical specialists in areas like cybersecurity, server networking. Again, that's according to their reports. But just overall in the session, I mean, it wasn't a great day because not only did you have that story from the Amazon side, you also had Anthropic saying its Claude chatbot can now take over a user's computer to complete tasks like navigating a browser, filling in spreadsheets as well. And then adding to the anxiety, of course, to start the week was Ares management and also Apollo Global Management that are limiting withdrawals from private credit. And again, that comes down to concerns really about loans to software makers. So overall, not a great start to the session. You saw that slump in the US. I just had a look at those Sydney names. They are a little bit mixed so far, but as you said, more names to watch, particularly in Japan later this morning.
Also an update on how OpenAI is managing its portfolio of products. What do we know about what it's planning to do with Sora?
Yeah, this is a really interesting move because, of course, Sora was launched about 6 months ago. It was a product, or it is a product that was in partnership with Disney, and lots of fanfare around this. But essentially, they're planning to discontinue this AI video generator just now essentially, but winding down that partnership as well with Disney. So this had, again, centered around Sora, that the agreement here was that Disney would be licensing iconic characters like Mickey Mouse, Cinderella to OpenAI for use on Sora, and then taking a $1 billion stake in the startup. So that deal was entirely based on stock warrants rather than a cash licensing fee. That's according to our earlier reporting on this. But essentially debuted in late September, promise of making it easier for users to generate and share realistic-looking AI videos. You're seeing some of those examples just there. But it has actually slipped in popularity because it did debut on the Apple charts or the App Store charts to the top, essentially, but since then has really fallen back. So, yes, a shifting of sorts, I guess, and a refocusing of OpenAI's portfolio to really streamline that product lineup. It is an interesting moment for the business because just separately, we do have that deal or reporting now that they're nearing the end of this funding round to close $10 billion from venture investors. So the total haul of the funding round, $120 billion, but the financing could be looking to close next week with investors including Andreessen Horowitz, but also Abu Dhabi's MGX, part of that reportedly as well.
And Annabelle, of course, another big AI player, Microsoft, and now we're hearing that they may have another facility in Texas.
Yeah, this is, again, I think one of the biggest conundrums, and we've discussed this a lot, of course, is just how do these hyperscalers fund or power their enormous energy needs. And so to that end, Microsoft has agreed to rent a data center, as you said, in Texas. It's actually in Abilene. It's an interesting one because it was originally developed for OpenAI and Oracle, but they later shifted away from that. But it is adjacent to their campus. Just in general, we did actually hear from Microsoft's president talking about how they plan to fund their energy needs. Take a listen.
We'll pay our way for electricity so that our data centers don't raise electricity prices for the neighbors. And that obviously means working early on with utilities and with those that will generate power.
So that sort of speaks to the broader needs of the business, how they also, of course, don't want to be risking the eye of a lot of consumers who are already really conscious of rising power bills, how they can actually get in front of that, fund their own needs. And to that end, Microsoft is stepping up its data center leasing, and you're seeing this as another example of that in Texas today.
Annabelle Drewell is there with the latest. In the meantime, some other tech stories that we're watching. Arm Holdings will start to sell its own chips for the first time, adding a business that it expects to generate about $15 billion annually within 5 years. CEO Rene Haas spoke to us exclusively about the new product and its aggressive sales goals.
It is a very big day for ARM. There's no doubt about that. We've been an IP provider since we've started. We started selling compute subsystems a few years ago, which was sort of the next step, but it's not a physical thing. But as we grew into the CSS business, we had customers that kept asking for more and more and more. And here we are today with ARM's first chip product, the ARM AGI CPU, which Meta is our lead partner for, and Meta asked us to do it with them. So we did.
Talk to me about Meta and the partnership then. One of your customers, OpenAI, also a customer. What are the commitments from Meta, from OpenAI to take this chip on board? When do you start shipping?
So as Mohammed said, it's available now, and we'll start shipping at the end of this year. We're not saying anything publicly about the volumes associated with it, but they are material enough that we have to start talking about the product because it's going to start showing up on our revenue this year.
The revenue starts showing up this year, and in your presentation earlier here in San Francisco, you talked about potentially just this one revenue stream, just this one part of the business, potentially $100 billion by 2030. Talk us through how you get to that $100 billion.
So we're looking here then, Tom, at the general purpose CPU TAM, which today in 2026 is about $60 billion, $70 billion, depending on your maths. I talked about agentic AI driving a 4x CPU workload even today. So $60 billion going to $100 billion by the end of the decade in terms of market opportunity is not really that much of a stretch.
How much of this is about that huge demand we're seeing, particularly here in Silicon Valley, for agentic AI? How much of this is aligned to that shift?
I think you have something key that's underpinning everything, and that's the demand for compute, period. And compute has been perceived in AI about just generating tokens. But those tokens need to be distributed, managed, orchestrated, scheduled. That's all work that only CPUs can do. So the more and more compute that drives agentic AI drives huge, huge CPU demand, which is great for the product we just announced today.
The other number that you announced was $1 trillion, and that's the entire business by 2030. You were a $4 billion revenue company in 2025, and you're looking at $1 trillion potentially by 2030. Just unpack that for us. How do you get to $1 trillion potentially by 2030?
Yeah, so what I showed there was a TAM, total available market, of $1 trillion by the end of the decade. And I showed a picture that had some other die photographs of things that we could do with the tagline, we're not stopping here. So more to come, but today is all about the ARM AGI CPU.
More to come. So you have the pipeline of CPUs. Do you move into GPUs? What else is involved in more to come?
The compute demand for AI is off the charts, and ARM is at the heart of literally every AI compute workload. So we have a lot of different ways to go address that.
ARM CEO Rene Haas speaking exclusively to Bloomberg's Tom McKenzie in San Francisco. For more insights on Asia's tech sector amid global geopolitical uncertainty, catch this week's episode of Bloomberg Tech Asia that's coming Friday at the times on your screen. And take a look at how assets are trading, with U.S. futures pointing to some upside. We had seen the paring back of some losses in the overnight session. Crude under pressure at the moment as well, but we continue to see the geopolitical tensions ramping up in the Middle East. We're just hearing from Kuwait that they're seeing damage after drones targeted a fuel tank at an airport, and that they're dealing with the fire after the strike. They're seeing no fatalities. We have more ahead. This is Bloomberg. We'll be watching Sumitomo Mitsui at the Open at the top of the hour. This after Bloomberg learned that it has no immediate plans to take over Jefferies. The Financial Times earlier reported that the bank was working on plans for a possible acquisition and has set up a team to act if Jefferies' price presented an opportunity. The report saw Jefferies' share jump in the U.S. We're also getting the latest BOJ minutes from their January policy meeting. One member saying that despite the fact that we're seeing upside risks to prices, there was no need for a rate hike at every meeting. Another BOJ member saying that the BOJ could be falling behind the curve. So a word of warning there, as the BOJ kept the rate steady at that 0.75% level in January and flagged risks to the outlook given the Middle East situation. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as we're seeing a little bit more of a risk-on tone, Haidi, early in the Asia session, perhaps stemming from those more encouraging comments coming from President Trump again around the Iran war. But we have to point out that really the news flow and the narrative around the geopolitical developments in the Middle East have been pretty confusing.
Yeah, can markets really trust that this has been sort of through the peak, through the worst of this conflict? There's still so much we don't know other than these reports of a 15-point plan being sent. We continue to see, though, indications of ongoing warfare in the Middle East, even with these talks of diplomacy.
Yeah, recently fire in an airport in Kuwait is the latest one that we're hearing about, some drone strikes in that country. But as we continue to follow the developments there, we're also looking at oil prices, which are under a little bit of pressure in the Asian session. And we are now seeing the Japanese yen holding at that 158 level against the U.S. dollar. Of course, we've been following the latest commentary coming out of the Middle East in order to see where prices of oil were headed. We have heard from the finance minister here in Japan about potential intervention in crude futures in order to ease the pressure on FX. You can see Nikkei stocks at the moment gaining more than 1.5%. We have seen gains in the previous session as well. We're watching JGBs as well. We have seen some gains after a solid 40-year auction. But it's really also the story around the tech sector that we're following. Of course, we saw a big software sell-off in the overnight session. Take a look at how Korea is coming online, because we've also heard in a regulatory filing that SK Hynix is actually seeking to list shares in the United States. We are now seeing the Kospi gaining about 2% at the open. We had seen gains of more than 2% in the previous session as well. A little bit more strength when it comes to the Korean won, but we're very, very close to that 1,500 level, Haidi.
Take a look, Shery, at the main game in town, of course, which is that focus on energy prices. We have seen sort of some pretty muted trading there when it comes to crude prices in the US. But of course, there has always been this fairly big gap between domestic US oil prices and what we see trading in Brent crude. But we are expecting that alleviation to continue. We're seeing Asian energy stocks on the pullback as well for another day. The US really saying that they see the possibility of diplomacy, as it's been worded there as well. Take a look at what treasuries are doing, taking a slide as these inflation woes also created weak auction conditions, I should say, overnight as well, as we continue to watch for these geopolitical developments. And President Trump saying that his administration is in negotiations with Iran, signalling that Tehran had offered an unspecified present related to energy flows as a show of good faith. Media reports in the US and Israel say a diplomatic push for peace is gathering pace, suggesting the administration may be seeking a one-month ceasefire.
They have no Navy left. They have no Air Force left. They have no anti-aircraft equipment left, no radar left, no leaders left. The leaders are all gone. Nobody knows who to talk to. But we're actually talking to the right people, and they want to make a deal so badly. You have no idea how badly they want to make a deal.
The talk of diplomacy comes with Iran maintaining its grip on the Strait of Hormuz, while Israel says its military campaign will continue at full intensity. The Pentagon said to be ordering 2,000 troops to the region. Let's bring up Bloomberg Politics editor Laura Zhai. As usual, this sort of flurry of headlines that, some of which seem to be quite contradictory. There's also another report suggesting that President Trump also, in comments to reporters, saying that Iran had agreed to abandon its nuclear ambitions. What do we actually know at this point?
There's almost something for everyone. If you want to see signs that peace talks may be coming, you can see that in today's news. If you want to see that this may be continuing for a while, and in fact that talks are escalating, you can also see that. So it's really a question of synthesizing all of this and figuring out kind of who is the most credible voice here. Trump continues sort of for the second day really hammering that he is talking with the Iranians, that he thinks a peace deal is possible. He said he's received a present, an overture from the Iranians involving the flow of oil through the Strait of Hormuz. He did not at all specify what that might be. But we also see signs both from the Israeli and the U.S. military that they're preparing to continue these attacks. Israel has a new fresh wave of strikes on Tehran this morning. The U.S. is sending even more troops, a fresh airborne unit to the region as well. That's on top of Marines that are already on their way. So there's a lot of mixed messages here about whether peace talks are ruling the day or if this is a sustained military conflict.
Any more signals, Laura, coming from Gulf states on whether or not they will jump into this conflict?
Gulf states are getting closer and closer to that precipice to being wanting to get into this fight. There's a couple things at worry here. One, if their critical infrastructure is attacked, that really becomes a red line for them, and they're sort of looking at sort of when they might hit that tipping point and need to jump into the fray. This is they have traditionally sort of stayed out of this conflict, but because things their civilians things like water infrastructure might be under attack, this has sort of become an issue. I think there's also concern within Gulf states that if Trump were to pull back, then they would be left quite exposed. So partnering with the U.S. seems like a better outcome for them than potentially in a go-it-alone strategy where their only kind of partner in this would be Israel, where there's a long history of strained relations.
Yeah, tell me about the role that Netanyahu, that Israel was playing into, signing off on any kind of ceasefire agreement.
Yeah, this has been sort of a conundrum. Trump has again given mixed signals here. There have been reports this morning about a 15-point, ceasefire plan that the U.S. has put together, as well as talk of a 1-month ceasefire. It's not clear at all if Israel has been involved in those, though Trump has previously said that any end to the war would be a joint decision made with Israel in terms of mutual benefit for both countries. So it's unclear, sort of if Israel is part and parcel in this, or if Israel, may be essentially jammed with taking with some of these proposals that the U.S. is talking about.
Our Bloomberg Politics editor Laura Zhai with the latest, and risk assets are in focus. Investors weighing these often conflicting reports that the U.S. has sent a peace plan to Iran. Garfield Reynolds leads our Markets Live coverage in Asia. We haven't even gotten to the big gift that he's been alluding to as well. Is there a lot for markets to be trading on with conviction?
I would argue no, but I'm commentating, not investing, and people who are putting money to work, they're obviously taking this as very much progress, even if most of what they have to focus on is an increase in US both public statements and reports citing unidentified officials that signals that the Trump regime, Trump administration, is very much interested in trying to find some sort of path to negotiations and toward peace. In other words, an off-ramp from this conflict. If this conflict was as unilaterally imposed as President Trump's tariffs about a year ago, then we would already have a fulsome rally, because he just would have said, okay, it's cancelled, and it would be cancelled. However, we have both Israel and Iran involved in this. They're still fighting. So you do have some measure of restraint. We've only got about a 2% gain in the Kospi at the open anyway, 1.5% or so for the Nikkei. You would need something from Iran, at least signaling that they might be willing to consider these latest overtures, for, you would think, for those gains to sustain. The bigger concern is that we might get something similar to yesterday, where gradually the optimism leaches away.
Especially at a time when we continue to see the Middle East conflict raging. We don't know where oil prices are headed. Yes, we're seeing a little bit of pressure today, but the fact that we might see that inflation spike because of the oil surge, are markets not completely factoring in the fact that central banks could tighten more than expected, given the also stagflation risks at this point?
Yeah, well, the difficulty is that investors, to some extent, have to be data dependent, as it were. While central banks have warned that they're willing to hike rates if this enhances inflation expectations, those rate hikes are still to come. And investors are busy trying to work out how long the conflict will go on and how much of an impact that will have, in particular on inflation expectations. I do think there's a serious chance that investors are underestimating what's going to happen to economies, both when it comes to inflation and to growth. We had the headline just out earlier this morning on Californian diesel jumping to $7 a gallon. That is an enormous hit to an economy that's famously as large as would be the world's 7th largest if it was a country. So that tells you that the damage to economic growth and to inflation, to the chances for restraining inflation, is real. It's coming. That's likely to be sustained, even if you do find an off-ramp. However, at the moment, traders are busy looking at the chances that there might be an off-ramp and that oil won't go much higher. The bigger concern has to be that oil, even if it doesn't go significantly higher than this, is going to stay at these sort of elevated levels, which are well above what we saw, obviously, before the war. And remember, before the war, there were signs that inflation was proving sticky around the globe.
Markets Live Asia team leader Garfield Vandel's there with his take of the market moves. Always great to discuss with you what's happening across markets as we are following the Japanese equity space as well. Softbank is one stock that we're watching. It's jumping at the moment more than 4.5%. ARM Holdings will begin selling its own chips for the first time, adding a business that it expects to generate about $15 billion annually within 5 years. The company's new chip, called an AGI CPU, will have as many as 136 cores and draw 300 watts of electricity. And Meta Platforms will be its first major customer. Coming up on the Asia Trade, we'll take you live to the Boao Forum for Asia, where our Chief North Asia correspondent, Stephen Engel, is leading our coverage. So, Steve, what's in store today?
Well, several days, obviously, of high-level conversations here at the Boao Forum. This is the 25th anniversary of this gathering down in the southern Hainan Island, and it's, in fact, the 20th year I've been here covering it. It gives you a good insight into how the Chinese are thinking, in particular, with the war raging in Iran, their thoughts about the oil shock on the economy. Just fresh off, of course, not only the National People's Congress, where they ratified and codified the next 5-year plan plan through 2030, but also just on the heels of the China Development Forum, which we were attending as well, up in Beijing. High-level guests, including Andrew Forrest, was at the CDF, gave a fiery speech there about energy diversification. We're going to be speaking to him later at 9:40 Hong Kong time to flesh out some of the thoughts he has on the war in Iran and the need to diversify to more renewable forms of energy. Lots on tap from the our day one of live coverage from the Boao Summit.
We'll have much more from Steve later this hour, but first, New Zealand's finance minister joining us as the war in Iran clouds the country's economic outlook and threatens to reignite inflation. Our conversation with Nicola Willis is next. This is Bloomberg. Let's take a look at the impact that the Iran war is having on the New Zealand economy amid rising inflation risks from the geopolitical situation. Joining us now from Wellington is the Finance Minister, Nicola Willis. Minister, really great to have you with us, and tell us, what are the impacts that you're seeing so far on the Kiwi economy from this ongoing energy crisis and the war?
Well, like many countries around the world, the initial impact has been a significant increase in the price of petrol, diesel and jet fuel, and that is of course affecting all New Zealanders, businesses and households alike. The petrol price at the pump has gone up about 30%. For diesel, a very important fuel obviously for industry, it's more than 50% increase, and so that price is having a significant impact. We do already have very good stock holdings of fuel in the country and on their way. These are minimum stock holding obligations which fuel importers into New Zealand need to meet. So we have fuel security, but we have stepped up a government response to anticipate that in the future there could be disruptions to supply, as we source a lot of our refined fuel out of South Korea and Singapore, and it's obviously that region of the world that has been impacted by disrupted access to crude oil out of the Middle East. So we are working closely with fuel importers to ensure that, if required, they are able to source alternative forms of supply.
I wanted to ask you about the impact on the fiscal situation, because there has been an announcement of targeted support to those who are most badly affected. How does that impact the other parts of the budget, and where will those costs be coming from?
We're determined to have a very responsible approach to how we respond to the unfolding crisis, and it's been our view that blanket reductions in the petrol tax or capping of prices is not an affordable response for New Zealand. We're in a period of fiscal consolidation, and we wish to stick to our goals of returning our books to surplus and bending our debt curve down. So we yesterday announced a temporary, targeted and very timely package of support focused on lower to middle income households with children, with working parents who we judge will be most impacted by the increase in the price of petrol. And so that package targets an additional $50 per week to those families. It is for the duration of either a year or when petrol goes back down to its long run average price for a period of 4 weeks or more. So that policy takes the lessons we have learned as a country. Our response to COVID involved very significant increase in public expenditure, and that has put us in a position with much higher debt than has previously been the case. So we're taking a careful, targeted approach.
Wouldn't you say that these are also, again, extraordinary times? Why not more support for the likes of farmers, small businesses, especially given also that it's an election year?
Well, we recognise that the increased fuel price is, of course, impacting every business in the economy in some way. Our first duty to those businesses is to ensure they have ongoing access to the fuel they need, and we have stepped up a significant all-of-government response to focus on that fuel security. So that's the first thing we're doing for them. Beyond that, it's our expectation that in the first instance, if businesses are having challenges with their working capital, or other issues with their finance, that they should turn to their commercial bankers for support in the first instance. And I've engaged with the major banks in New Zealand, and they share my view that that is a responsibility that falls to them in the first instance. As the events unfold with this crisis, which I think the whole world is watching evolve in real time, we've said as a government we will take a careful and measured response. We're working very closely alongside industry and business to understand what they need. And they've reiterated to us very clearly that in the first instance they're relying on us to do everything we can to ensure they have access to fuel.
How much slower?
We have heard from the RBNZ governor, for example, in the previous Sorry, I was just going to ask about the RBNZ governor and her comments that they will really not be rushing to raise rates. But at the same time, we have seen some banks who have already raised home loan interest rates. What do you make of that, and do you agree?
Well, look, I think there's two things going on. The first is, of course, internationally, we've seen wholesale funding markets see increases in borrowing and the yields. And so, of course, New Zealand is not immune to that. And you're seeing that reflected in some of the commercial decision-making by our banks. At the same time, of course, the Reserve Bank has a job to do with its own monetary policy settings. But what the Reserve Bank governor set out yesterday clearly was what I'd call central banker textbook stuff, which is that in the first instance for a price shock, an increase in the OCR would not be the appropriate response given the other demand effects at play. However, the Reserve Bank was conscious of its medium-term mandate to keep inflation between 1% and 3% and would be watching most carefully those ongoing inflation expectations and secondary effects. So it does appear that the markets here have reacted to that statement. It's seen some nervousness disappear because they've taken the message that that means there won't be imminent increases in our official cash rate.
Mr. Willis, if you were to take a look at modelling, which I know is difficult to do given the flux of geopolitical developments, how much slower do you think economic growth could be?
We are fortunate in that we came into this period in a very healthy state as an economy. Our growth had recovered after what has been a challenging period post-COVID. We were forecasting growth of 3% this year. And we've now had to, of course, go and look at how those forecasts will be altered by current events. Like everyone, we're analysing a range of different scenarios relating to how long the conflict endures, how long supply chains are disrupted afterwards, how high prices for fuel will go. So in those scenarios, we see lower growth occurring. But even in some of the worst case scenarios, we are still at this point anticipating our economy will continue to grow positively this year, but not as fast as it was going to. We are anticipating higher levels of inflation. And of course, we are being prudent as a government to ensure that our fiscal response doesn't inadvertently pump prime and exacerbate those inflationary pressures in the economy.
Nicola Willis, really good to have you with us. She's the Minister of Finance of New Zealand. Thank you very much for your time. We do also have breaking news that's coming from the information that SpaceX is now looking to file for an IPO as soon as this year. They could try to raise over $75 billion in the IPO. We had been waiting for this announcement. SpaceX is aiming to file its initial public offering prospectus with regulators this week or next. Now we're hearing from the information that they're aiming to file it as soon as this week. They are going to try to really raise that $75 billion with a valuation of $1.25 trillion. They could be allowing individual investors to buy a higher portion of shares than typical IPOs, according to this report. We'll have more ahead on the Asia trade. This is Bloomberg.
The the top global headlines that we're following, and Chevron is warning that California is heading towards an energy crisis because of the Iran war. State officials should declare an emergency, is what they're saying. The company says it may quit refining oil in the state within a decade unless officials roll back taxes and regulations. California is highly exposed to the disruption as it imports about 20% of its refined fuels. Iran has stopped natural gas exports to Turkey following last week's Israeli strike on the giant South Parts gas field. But sources also say Ankara is still importing gas from its main suppliers, Russia and Azerbaijan, and can continue using gas held in storage. The energy minister told state broadcaster TRT that Turkey is not facing any gas supply issues and storage facilities are 71% full. Brazil will soon unveil a new program to provide financing to companies struggling with the impact of US tariffs and the war in the Middle East. President Lula da Silva is set to sign a provisional measure soon, offering $2.9 billion in credit. According to a draft seen by Bloomberg, a wide range of companies may qualify, from manufacturing exporters to fertilizer producers. Venezuelan opposition leader Maria Corina Machado says a government led by her would allow the country's oil sector to go fully private. Speaking to oil and gas executives in Houston, Machado said that she would offer 25-year concessions and full property rights to investors. Machado also said that she expects elections in Venezuela soon without giving a specific time frame.
And take a look at some of the big movers in the Asian session. We're following Softbank jumping after ARM reported that they will begin selling its own chips for the first time. That's adding a business that expects to generate about $15 billion annually within 5 years. SK Hynix also on their regulatory filing that they are seeking now to list in the United States. We're also watching software stocks across Asia. We have seen those ETFs in the U.S. session tracking software stocks, seeing the worst drop in a month. Disruption fears are rampant. There was a report that AWS will be developing AI agents replacing roles, so that disruption fear is just intensifying. Anthropic also said its Claude chatbot can now take over a user's computer to complete tasks such as navigating a browser and also filling in spreadsheets. Still ahead, JD.com's vice president and chief economist joining us live from the Boao Forum to share his outlook on China's pivot to consumer-driven growth. You're watching the Asia Trade. This is Bloomberg.
Take a look at what we're watching when it comes to inflation data out of Australia at the moment. We are seeing February trimmed mean CPI rising to 0.1%, easing slightly from the 0.3% in January. Year on year, that number coming through at 3.3%, a little bit softer than expectations of 3.4%, and also easing from the previous month of January as well. This as we continue to watch for really central bank policy and how hawkish central bankers will have to be to get on top of the inflation risk. We've seen really the RBA being at the forefront of that, of not wanting to risk an entrenched inflation psychology being put in place there as a result of rising energy prices and the impact on that broader inflation reading. But pretty muted in terms of these numbers that we're seeing, at least not particularly outside. 3.7% is that headline year-on-year number, a little bit softer than expectations, with no move when it comes to CPI on that headline month-on-month number. Let's head back to Hainan Island in China now, where our Steve Engel is standing by with our first guest from the Boao Forum.
Yeah, it's getting hot here, obviously. It's just early morning, but the tropical sun is out. And, of course, this is the 25th anniversary of the Boao Forum for Asia, my 20th attending this. It's a good pulse check, obviously, of how Chinese leadership and Chinese corporates are thinking. It comes right on the heels of the China Development Forum in Beijing, which was held this last weekend, and a few weeks after the National People's Congress, where, of course, this year they formalized the next 5-year plan through 2030. To break down what is happening in the Chinese economy and its impact, obviously, from the turmoil in the Middle East, we'd like to welcome in Jianguang. He is JD.com's chief economist. Thanks so much.
Thank you very much.
This early morning coming here and appearing on Bloomberg Television. What has been the economic cost so far from the last 4 weeks since war erupted in the Middle East on the Chinese economy? They're fairly well shielded for the short term on the energy front, but what's been the economic cost so far?
So far, you see the government also raised the gasoline price. Definitely it will increase inflation and also, dampen some companies' profitability. But on the other hand, China is probably, I think, is the best country to weather this storm. And for one thing, I mentioned about inflation impact. China is actually has experienced negative growth in PPI.
4 straight years.
You are right. And now this year, because of energy, because of gold price, and the PPI can be positive this year. I think that's not a bad thing because it can defeat these deflation expectations.
But if this turmoil and the oil shock and the inflationary pressures continue, it could also be a dampener on corporate profits because this is not demand-driven inflation. It is cost-driven.
You are right. For some part of the economy. But on the other hand, you can see China has invested so much on this, solar panel, wind power, these new energy sectors. And then you can see it's not only the demand from domestic, but also from international, buyer demand will definitely increase because people understand that this new energy sector is so important. It's not only it's a green, it's a low carbon contribution to the world, but also it can defend against turbulence and this disruption in the traditional oil market.
If this oil shock is persistent and lasts longer and well beyond what they're talking about now as a possible truce, but again, a lot of people are saying the oil prices could potentially stay high for quite some time. The Boao annual report talks about Asia-wide growth dipping down to maybe around 4.5%. Not a bad number, not off the cliff, but still down from last year's estimate of about 4.7. So as a whole, what's kind of the worst case scenario for these very trade-dependent economies?
Oh, definitely. If you think about it, if that's sustained for a long term, that will be another oil shock. This supply side shock, as in the 70s, right? So definitely it will be very negative for the global economy. But what I'm saying is, a lot of countries will be affected. But which one will be affected less, right?
Yeah,
That's why I think China and also Asia countries. Of course, you can see China has, restricted gasoline exports, right?
Yeah.
So that's already affected some Southeast Asian countries because they are so much dependent on Chinese imports, right? So definitely, have some negative impact. But as I mentioned, because of heavy investment in energy sector, in the electricity sector. As I was in Davos this year, and Elon Musk said, China has invested so much, and it will be so advantageous in AI sector, for example.
Yep.
Right? You need energy, you need electricity. That's how. I think there's some reports saying China last year, had installed new electricity, capacity is like 10 times as large as the U.S. Right? So that's actually, can help China weather this kind of oil shock.
If this oil shock lasts a long time, what in this year, because at the National People's Congress, they did not roll out a lot of stimulus. And even we just heard just a couple of days ago, the PBOC Governor Pan Gongsheng says, we don't see needing to weaken the renminbi to boost exports because, of course, their import bill is going to be a lot higher, so a stronger yuan actually helps them. But what kind of stimulus would you expect the Chinese to employ? Because keep in mind, their GDP, debt to GDP ratio was kept at a fairly high level at 4%. They do have room, would you say, to unleash some stimulus if the domestic economy starts suffering?
Oh, that's right. Of course, the Chinese government has been rather prudent in not incurring a large amount of debt, right?
Yeah.
So 4% is the same as last year. right? And also, but on the other hand, 4% is quite sizable. If you think about additional fiscal stimulus, about special long-term government bonds and the local government bonds allowed by a central government to issue, right? That's all in the historical high level. And on the other hand, you can see also there's using military tools, this kind of financing by the major banks to finance the infrastructure projects. They allow this bank loan to be the equity capital for local government actually to start. So that's why the Chinese government started 109 mega projects, right now this year. So to boost infrastructure investment.
Jianguang, great to talk to you. We didn't even talk about consumption, which is obviously going to be a pillar of this next 5-year plan, boosting domestic consumption to also sort of shield the Chinese economy from those external shocks as much as they possibly can. Thanks so much for your time on Bloomberg Television. Okay, much more coming here from sunny Hainan Island and the Boao Forum.
Yeah, great conversation there with Stephen Engel from Boao Forum, and that was the chief economist, of course, when it comes to JD.com. We do have more with the Fortescue Metals founder and executive chairman, Andrew Forrest. He's joining us during the China show. He labels fossil fuels a weapon of war. The Philippines has declared a national energy emergency that will be enforced for a year. This as the war in Iran disrupts global oil supplies. Prior to that declaration, President Ferdinand Marcos Jr. told us exclusively that the ongoing conflict in the Middle East could spur a breakthrough in the energy talks with China.
I think it's certainly going to happen. I don't think that's something that that is like an option. It's happening now. There's going to be a very, very serious restructuring. I remember I was watching Prime Minister Wong from Singapore, and he was saying we will have to redraw all of our even our legal relationships in terms of the international law, in terms of all of these things. They will have a lasting effect. And there will have to be a new normal.
Is there reason to think that maybe it is a good idea to have a partnership in developing the gas resources in the disputed areas in the South China Sea?
We've always tried to differentiate the territorial disputes from our trade arrangements, and many investments still of the big programs here of the government are coming from China, and they have not used this as somehow, they haven't leveraged this in any way. In quite the contrary, they have been very, very helpful in terms of, for example, fertilizer, which is we import a great deal of fertilizer from China.
So would you consider developing gas resources with China in the disputed regions, areas in the South China Sea? Is that something you might consider?
That's something that we've been talking about for a great deal. But the territorial disputes will get in the way of that. Maybe this will provide impetus for both sides to come to an agreement.
The Iran war, do you support the U.S.-Israel war against Iran?
It certainly was unexpected. And we never want war. Our foreign policy is very, very simple. It's peace and the national interest. That's it. And war is never in the national interest as far as the Philippines is concerned. And so we just are hoping that this ends soon, and that whatever recalibration will be done as quickly as possible, so we can get back to work. And that's really where the Philippines is. We are watching, waiting, hoping, and praying that this ends soon.
The war has sent the Philippine peso reeling, 60 to the dollar. It's testing new lows after new lows. Do you think the BSP needs to tighten policy to hike rates to support the currency?
as a matter of policy, we defend the peso to a certain extent. But I think, with the dollar moving the way it is, and it's moving, whereas before the dollar was seen as a safe harbor currency. When you look deeper into it, the dollar's movement increase in value has been really because they're the largest oil producer, and that's why that is. And considering that, then we have to. I think it would be even to be futile to try to spend all of this, all of our foreign reserves on defending the peso. The impact of all of this of the war in the Middle East is really to the middle income and the lower middle income countries, and we are a middle income country, and so that's why we have to look at that. The other side of that for the Philippines is the remittances. The remittances are paid in dollars. And so there will be an increase, but that doesn't make up for the drop in the dollar to peso.
One of the key challenges is the economy. The Philippines used to be one of the fastest growing in the region, now a laggard. Fourth quarter GDP was a mere 3%, which was the slowest pace in 14 years outside the pandemic. Can you get GDP back above 6%?
Yes, we believe we can. I mean, we were forecasting for the year 26. We were going to manage 6-7%, between 6 to 7%, and that figure was something that we came up with internally. But as well, the other financing institutions and the banks seem to have had the same opinion, because the improvement in our grade on S&P was going to improve. However, with the war in the Middle East, those have to be redrawn. Everything has to be redrawn.
Philippine President Ferdinand Marcos Jr. there speaking exclusively with Bloomberg Insight anchor Haslinda Amin, of course, talking about the impact of the war on the Philippine economy. But take a look at what we're watching when it comes to oil prices as markets and investors continue to try and digest these headlines relating to the possibility of diplomacy, the reports of potentially ceasefire talks, there's reports of a 15-point document being sent to Iran as well. So there's a lot of cross currents, including also reports of 2,000 troops being deployed in the region, as well as strikes continuing on Iran from Israel. So we're seeing a bit of downside now when it comes to trading in crude. New York traded crude down by just about under 6% there, and we have seen that sustained drop as a result of these reports of the US diplomatic push to try and end this conflict, or potentially start the pathway to a one-month ceasefire for ongoing talks. This, of course, has triggered such an energy crunch. Oil still, even with the recent pullback, remaining on track for a substantial monthly surge. Petroleum products has also been rallying in recent weeks as well. Let's take a look at broader markets that are, of course, also tracking perhaps a little bit of a risk-on sentiment. The Nikkei 225 up there by over 3%. We're seeing some gains across the Kospi there as well. Here in Australia, despite the losses being sustained by the likes of Woodside and Santos, the energy-related names that have rallied over the past weeks, we are seeing broad risk-on appetite with gains of over 2%. But oil really clearly the driving factor as we see stocks continuing to rise, the optimism strengthening around that push by the US to potentially resolve the Middle East conflict, which is going on for almost a month now. More ahead on the Asia Trade. This is Bloomberg.
Keep an eye on tech stocks across Asia, especially with the likes of SK Hynix now seeking to list in the U.S. this year. They want to raise money for memory demand from artificial intelligence. The company made a confidential submission to the U.S. Securities and Exchange Commission for an ADR listing. SK Hynix right now ramping up investment in new capacity to meet AI's escalating needs for rapid access to data. And you can see Softbank, they're gaining more than 7.5%. Of course, they're the majority stakeholder of ARM Holdings. The company will begin selling its own chips for the first time, adding a business that it expects to generate about $15 billion annually within 5 years. CEO Rene Haas spoke to us exclusively about the new product and its aggressive sales goals.
It is a very big day for ARM. There's no doubt about that. We've been an IP provider since we started. We started selling compute subsystems a few years ago, which was sort of the next step, but it's not a physical thing. But as we grew into the CSS business, we had customers that kept asking for more and more and more. And here we are today with ARM's first chip product, the ARM AGI CPU, which Meta is our lead partner for, and Meta asked us to do it with them. So we did.
Talk to me about Meta and the partnership then. One of your customers, OpenAI, also a customer. What are the commitments from Meta, from OpenAI to take this chip on board? When do you start shipping?
So as Mohammed said, it's available now, and we'll start shipping at the end of this year. We're not saying anything publicly about the volumes associated with it, but they are material enough that we have to start talking about the product because it's going to start showing up on our revenue this year.
The revenue starts showing up this year, and in your presentation earlier here in San Francisco, you talked about potentially just this one revenue stream, just this one part of the business, potentially $100 billion by 2030. Talk us through how you get to that $100 billion.
So we're looking here then, Tom, at the general purpose CPU TAM, which today in 2026 is about $60 billion, $70 billion, depending on your maths. I talked about agentic AI driving a 4x CPU workload even today. So $60 billion going to $100 billion by the end of the decade in terms of market opportunity is not really that much of a stretch.
How much of this is about that huge demand we're seeing, particularly here in Silicon Valley, for agentic AI? How much of this is aligned to that shift?
I think you have something key that's underpinning everything, and that's the demand for compute, period. And compute has been perceived in AI about just generating tokens. But those tokens need to be distributed, managed, orchestrated, scheduled. That's all work that only CPUs can do. So the more and more compute that drives agentic AI drives huge, huge CPU demand, which is great for the product we just announced today.
The other number that you announced was $1 trillion, and that's the entire business by 2030. You were a $4 billion revenue company in 2025, and you're looking at $1 trillion potentially by 2030. Just unpack that for us. How do you get to $1 trillion potentially by 2030?
Yeah, so what I showed there was a TAM, total available market, of $1 trillion by the end of the decade. And I showed a picture that had some other die photographs of things that we could do with the tagline, we're not stopping here. So more to come, but today is all about the ARM AGI CPU.
More to come. So you have the pipeline of CPUs. Do you move into GPUs? What else is involved in more to come?
The compute demand for AI is off the charts, and ARM is at the heart of literally every AI compute workload. So we have a lot of different ways to go address that.
CEO Rene Haas there, speaking exclusively to Bloomberg's Tom McKenzie in San Francisco. Well, the top corporate stories that we're tracking, and Apple is testing a standalone app for its Siri voice assistant and a new Ask Siri feature as part of a broader AI overhaul. Sources say the new Siri is designed to tap into personal data and interact with users in a conversational format through text and voice. We're told the upgrade should be unveiled in June at Apple's developer conference. Ares Management has joined Apollo Global in limiting withdrawals from their funds to 5% of shares after clients sought to redeem more. The combined caps mean roughly $1.5 billion worth of redemptions will be blocked and remain invested in the funds. This tracks a broader move as investors grow anxious about a liquidity squeeze in private credit markets. Xiaomi has posted its slowest quarterly growth since 2023 after strong sales of its EVs failed to make up for slumping smartphone demand. Sales in the December quarter rose 7.3% to $17 billion. The EV division shipped more than 145,000 cars in the period, more than double a year earlier, and posted profit of $160 million. Chinese AI startup DeepSeek has posted job openings for specialists in agentic AI as enthusiasm grows for technology that can carry out tasks without human intervention. The 17 listings mark a shift beyond traditional large language models towards agents. China has been swept up in agentic AI fever amid rapid adoption of the open source tool OpenClaw.
And for more insight on Asia's tech sector, do catch this week's episode of Bloomberg Tech Asia that's coming up on the times on your screen. And take a look at how futures are setting up. Of course, we're headed towards China market opens. We are now seeing more optimism spread across the Asia session. We do have MSCI Asia stocks gaining more than 1.5%, with oil prices under a little bit of pressure on signals that perhaps the geopolitical tensions around Iran might be subsiding soon. President Trump talking about this present coming from Iran as a show of good faith. You can see FTSE A50 futures finishing to the upside of 0.25%. TAIEX futures also pointing to upside of more than 3%. In fact, the Taiwanese dollar outperformed in the overnight session. That's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. The China show is next. This is Bloomberg.